Alright everyone, the show continues, and it's time to dive into why the dollar is under immense pressure. Chinese corporations are playing a decisive role in undermining the greenback, while the Federal Reserve's own policies are piling on additional damage. This combination is dragging the currency downward on a global scale. Look no further than gold. It recently soared to $3,700, not because gold itself suddenly became more precious, but because the dollar itself keeps eroding. The weaker the dollar, the higher hard assets climb. And with the direction things are moving, the odds of interest rates sliding beneath 3%, or even touching 2% by the middle of next year, are very strong. Goldman Sachs already projects no fewer than 3 rate reductions this year, and that's considered a cautious estimate. If the current course continues, rates will dip under 4% soon, and by late 2026, 3% or below is highly probable. Yet markets still fail to grasp how deep the cuts might actually be. Many investors still assume rates will stay above 3% next year. But if Goldman's projection plays out, or if the outcome is harsher, we're heading straight into dangerous territory. Imported inflation will bear the brunt of the impact. Now here's the critical piece. Slashing rates strips away the motivation to hold dollars. Treasury returns diminish, and global investors begin shifting their money elsewhere. This effect is even more pronounced during a trade conflict when demand for the US currency is already slipping. At the end of the day, it's all about supply and demand. And right now, a perfect storm is brewing. Steep rate cuts, tariff battles, asset seizures, and geopolitical pressure, all weighing heavily on the reserve currency. This isn't just temporary noise, it's the slow unraveling of the dollar's global role. And things get even more concerning. Large Chinese firms are no longer relying on dollar funding. For decades, the dollar reigned supreme as the world's borrowing currency. That era is fading. Companies like Tencent and BYD are now issuing massive volumes of yuan-denominated bonds, commonly called dim sum bonds, to obtain cheaper financing. Why? Because the new technological arms race, fueled by Trump's policies, forces Chinese industries to secure enormous sums for chip development, AI, and high-end infrastructure. This year alone, Tencent and BYD have raised more than 23 billion yuan through offshore bonds. And that's just the start. Capital needs will multiply as competition escalates. The process is straightforward. When businesses issue dim sum bonds, they borrow in yuan rather than dollars. That increases worldwide demand for the Chinese currency while decreasing appetite for USD. And why yuan? Because China is essentially self-sufficient. You can purchase nearly everything domestically. It remains the world's manufacturing hub. That's why more and more corporations are favoring yuan financing. The growth is astonishing. Back in 2019, issuance was under 8 billion. Today it's pushing close to 50 billion. That's a direct crack in the foundation of the global dollar system. Each yuan bond issued is one less reason for international markets to rely on US currency. Looking ahead, this trend will only accelerate. As China pours capital into artificial intelligence, semiconductors, and clean energy, de-dollarization will surge to new heights. And here's a crucial angle many overlook: the cost of capital. The cheaper you can borrow, the more competitive you become. A company that can raise funds at 2% has a huge edge over a rival stuck paying 5%. Lower financing costs mean faster expansion, more investment, and greater tolerance for mistakes. It's an advantage baked into the system. Just look at Tencent's latest deal. It issued 5-year dim sum bonds at only 2.1% interest, cheaper than the US government itself pays. By comparison, US tech giants like Intel and Nvidia are issuing dollar-denominated bonds at 4 to 5%. They are being squeezed hard. And this doesn't even factor in currency movements. Analysts such as Stephen Jen predict that the yuan is set to strengthen significantly. Beijing is likely to allow its currency to appreciate, both to attract capital away from Wall Street and to avoid backlash from trading partners as Chinese exports dominate markets. Other manufacturing nations like Japan are already losing ground. That makes a stronger yuan not only possible but likely. If Jen's forecast comes true, the yuan could rise to 6.25 per dollar, a 14% appreciation. In currency terms, that's massive. Such a move would make dim sum bonds even more attractive, combining cheaper borrowing with a rising currency. Firms would gain both cost savings and long-term value, without needing to rush their spending. This could be further magnified by the trillions already sitting abroad. Chinese corporations hold over $2.5 trillion in liquid assets overseas. If the dollar keeps weakening or trade disputes worsen, that money could pour back into China, lifting the yuan even higher. And this is where Trump and advisors like Scott Bessent are completely blind. Bessent continues to argue that everything is under control, praising Trump as a master strategist. But in reality, this mindset only ensures deeper rate cuts, further dollar depreciation, and a quicker global pivot toward yuan financing. The dollar's dominance is no longer just challenged, it's being dismantled piece by piece. And if these developments continue, the global financial order will look entirely different within the next decade. According to Scott Bessent, there's supposedly no inflation issue in the United States, and he's urging the Federal Reserve to speed up rate cuts, as if that's the answer. But this move does not safeguard the dollar's reserve status. It only proves that Trump and his allies are willing to torch the currency just to keep this fragile, hollow economy staggering forward. And the fallout is tragic. America's wealth gap isn't just widening, it's about to detonate into something far more dangerous. Look at the wild swings in the dollar every time the Fed makes a decision. Just yesterday, the central bank trimmed rates by 25 basis points while admitting the labor market is softening. Immediately, the dollar plunged to its weakest level since 2022. Then, in response to Jerome Powell's reassurance that the cuts wouldn't be too drastic, the dollar snapped back, retracing the collapse. On the surface, it may look like nothing changed, that we're simply back to square one. But beneath that surface, the cracks are visible, and this is where we have to pay attention. The Fed's dot plot is the smoking gun, showing how divided the institution has become. On one side sits Stephen Moran, Trump's appointee inside the Fed, pushing aggressively for lower rates and a weaker dollar. On the other side, just back in July, most governors were calling for higher rates in 2025 and 2026. Now the consensus has splintered, with more and more officials demanding sub-3% rates by the end of 2026. The split is undeniable. Pressure for steeper cuts is mounting. And Trump won't stop here. He'll continue stacking the Fed with loyalists. Moran is the first, but he won't be the last. This is political capture of the most powerful central bank on earth. And beyond the Fed, the symbolism is just as loud. On the very day rates were cut, a massive golden statue of Trump holding Bitcoin appeared outside the Capitol. A 12-foot idol for crypto fans, who are celebrating the debasement of the dollar as if it were liberation. But underneath the spectacle lies a darker reality. A weaker dollar imports inflation straight into American households. The U.S. still depends heavily on foreign goods and raw materials. Meanwhile, tariffs designed to protect employment are crushing jobs instead. Payrolls are shrinking, joblessness is rising, and what Powell has now admitted is that the U.S. has stumbled straight into stagflation, slowing growth mixed with rising prices. This is exactly what has been warned about for months, and now Powell himself has acknowledged it. Business activity is cooling, inflation is climbing, and yet the Fed is being cornered into cutting rates to keep the economy on life support. The dollar itself becomes the pressure release valve. And as the dollar bleeds lower, countries are moving away from it. They don't want to purchase dollar bonds, nor do they want to issue them. Trust is slipping away. The big question is how long this decline can last. History suggests it could endure for years. The previous dollar down cycle dragged on for 13 years, from 2001 until 2014, bringing with it the housing collapse, the global financial crisis, and trillion-dollar bailouts. If Trump pushes the trade war forward while forcing rate cuts, America could be trapped in another decade-long dollar downturn. Such a collapse would shake the very bedrock of the U.S. financial system, which depends entirely on a steady currency. If the dollar keeps dropping like a stone, will the world continue to trust American assets? Or will capital flee elsewhere? Shockingly, that elsewhere is no longer Europe or Japan, but emerging markets. Once considered untouchable, their currencies and bonds are now producing the world's strongest returns. The Brazilian real is up nearly 6%. The Turkish lira, once a symbol of instability, is up almost 5%. Under normal conditions during a trade war or crisis, these currencies would crumble against the dollar. But now the tables have turned. Investors are betting that the dollar itself is the greater risk. They're chasing high-yield emerging markets, pocketing big interest payments, and then reaping capital gains when those currencies appreciate against the weakening greenback. profiting on both ends. That's how upside down this system has become. And here's the dangerous part. The lower US interest rates go, the more distortions will appear. Every cut sends tremors through global markets. Every cut accelerates capital flight. Every cut undermines the dollar further. Which raises new questions. Will corporations abandon dollar loans in favor of Chinese yuan debt? Will nations continue to reduce their reliance on the greenback? Will the Fed fracture even further under Trump's pressure? We are in uncharted waters. The dollar, the cornerstone of modern global finance, is under siege from both within and without. The shift has already begun. Capital is flowing away. Confidence is evaporating. And the rules of the past no longer apply. So the real question is this. Are we witnessing the early stages of a dollar collapse that could drag on for a decade? And if so, will emerging markets be the shocking winners in this historic reset? Share your views in the comments, stay safe, and remember to like and subscribe as we track this turbulent storm together.